Let me start with a scene you probably know very well. It's a normal day. You open your phone and a headline, it's you like a punch, something geopolitical, something about a crisis, something that makes you think this time is different. I should protect myself. Into the last year, that feeling showed up again and again. And yet, when the year ended, the market left a message that was almost rude in its simplicity. The investors who stayed calm were rewarded. The S&P finished again up close to 18% after already delivering 2 years in a row with 25% plus gains before that. That's not a normal streak. That's the kind of run that makes me people feel smart and then very quickly makes people feel terrified that it can continue. So today, I want to do something different from the usual market commentary. I want to speak to you directly, like I'm writing a letter to a friend who invests and sometimes doubts themselves. I will tell you what the last year taught me with real numbers and what I'm watching this year without every jargon. And at the end of this episode, if you will stay until the end, I will share the simplest investing goal I know. Building a plan you can actually stick with when the words get loud. Good morning, everyone. I am Alessandro. I am the founder of Macro Mornings, a global international community which count more than 53,000 global investors, where I share my insights, my analysis, my deep dive macro sensitivities, and so on. If you are interested, you can find the link in the description. Join with us and subscribe it today. It's totally free. And I want you to sit with it for a second, with my mind and with my consideration. If you miss the 10 best days into the S&P 500 during the 2025, your return wouldn't have been around plus 16%. It would have been roughly minus 12%. That's not a small gap. That is an entire life lesson in one line. And this is why market timing is so emotionally dangerous. The best days often happen close to the worst days. They arrive after fear, after confusion, after the moment when you feel least confident. Into the last year, the market even delivered one of the fastest comebacks after a big drop. From the April low, it took only 55 trading days for the S&P 500 to recover their entire loss. That's insane. Then, within about 125 trading days, it was up roughly 35% from that low. In the history of major corrections, that speed is really rare. So when I think about this year, I don't start with a question, what will happen? I start, guys, the question, how do I avoid making the one decision that ruins everything? Selling because I'm scared right before the rebound. What surprised me most the last year was only America and big tech. People talk about the last year like it was just AI and the US stock market. Yes, AI was a major engine. I totally agree. But the world was bigger than that. And the numbers outside the US were honestly wild. European banks were up 90%. Japan was up around 50%. Korea surged roughly almost 80%. And even China had moments that surprised many investors. Shenzhen was up about 22% over the period discussed into the report, close to the Nasdaq rise in the same window. Then you had commodities moving like it wasn't a normal year at all. Gold gains about 65%. its best annual rise since 1979. Silver jumped about 148%, more or less. So moves like that usually happen when investors are repricing big fears like inflation risk, geopolitical risk, and long-term trust in paper assets. International performance was not only about stock prices, of course. A big chunk came from currencies. The US dollar fell about 7% in real trade weighted terms, and we show very well into our macro asset dashboard. And if you become a free readers of macro mornings, you are going to receive all of this stuff in real time, all right, weekly, as thousands of people are already doing it into the macro morning space. So click the link in the description because it's totally free. But we have seen the euro has rose about 13% versus the dollar, and currencies gain explain a huge portion of USD-based returns in Europe, around 44% for Europe overall, with similar wow figures in several major countries. When I see numbers like that, it reminds me of something really practical. Global diversification is not a slogan, it's math. And this year, if the dollar keeps drifting lower, even gently, it can quietly boost international returns for US dollar investor. A lot of investors wanted 2025 to be the year inflation disappeared from the story. But the reality was more stubborn. Inflation stayed above target for about 55 months, a long stretch that keeps central banks cautious and keeps markets sensitive to inflation surprises. Now, I'm not saying inflation will explode. I'm also not saying we are going back to the 70s. I'm saying something more useful for all of us. In 26, I don't want a portfolio that only works in a perfect world, where inflation never comes back. That's why I still respect the real assets. I respect the diversification. And I don't assume the last decade's rules will automatically return. The numbers that tells me investors are still nervous is $7.73 trillion in cash. There is another number that tells a very human story. Money markets found assets ended the last year with around $7.73 trillion. That's a mountain of cash. And what makes it even more interesting is that it stayed high even after the Fed cut rates by about 175 basis points since September 24. In other words, rates come down, but cash didn't leave in a rush. To me, that says something simple. People want safety, they want control, they want comfort. And of course, I understand that. But I also know the hidden danger. If you sit in cash for too long, you often miss the market's biggest jump, those best days we talked about earlier. And if confidence rises, even a small shift out that cash pile can support markets. But if fear rises, that cash pile can grow even bigger and people can get stuck waiting for the perfect entry that never arrives. So let me share the base case expectations in my view described into the outlook, but in plain language. The broad view going into this year, in my view, is constructive. So growth can continue, the bull market can continue, and earnings can remain supportive. Just with more bumps, more rotations, and more headlines, of course. The forecasters points to US growth rate around 2-3% zone, with full year real GDP around 2.4%. Global growth is set around 3.3%. Inflation forecast is over near 3% for CPI and about 3% for core CPI in 26. Unemployment rate is seen around 4.5%, and policy rates are expected to drift down toward roughly 3.1% by late 26. If I translate, make it moving forward, but not smoothly. And that matters because markets are not cheap everywhere. Confidence is already partially priced in. The report even gives a snapshot of index levels around early January 26, with the S&P 500 near 6,800 points, the Dow around 48,000, and the Nasdaq around 23,000 points. Levels change, of course, every day, of course, but the point is we are not starting from a depressed place. All right. So my mindset in 2026 is I want to be optimist, but not naive. For years, many investors treated bonds like an afterthought. But in 26, bonds are back in the conversation because yields are meaningful again. The snapshot into the outlook showed yields roughly around 3.6 for short cash yields, about 3.5% for 2-year treasuries, roughly 4.2% for 10-year, and around 4.9% for 30-year. In credit, numbers were also notable in my view, around 4.3% for US investment grade and about 6.5% for high yield. Why do I care? Because when yields are low, bonds are mostly stability. When yields are higher, bonds can become stability plus income, and sometimes stability plus income plus price support if rates fall. That's important to understand how the macro mechanism could work. And if the expected policy path brings rates closer to the low 3% area by late 26, as we have reconstructed into this episode, that bond compensation becomes even more important in my view. Now, I wanted to touch something that affects the real world more than the charts: jobs and labor market. The overall unemployment rate can look fine, but underneath, the experience is different depending on who you are. A striking number in the report, unemployment for ages 16 to 24 was about almost 11%, exactly 10.6%, while the overall rate, of course, was around 4.6%. That's a big gap, and it matters because younger workers drive a lot of future consumer behavior, new apartments, new spending patterns, new confidence. So when I think about consumer stocks or consumer demand in 26, I don't just ask, is the consumer strong? I always ask, which consumer? That's the reality of this cycle. It's not uniform, it's uneven. And investing becomes easier when you accept that. And now we have artificial intelligence, and we can't ignore it. The way I see it, the last year was the year AI built momentum. This year, the market starts asking, where is the productivity? Where is the profit? Sorry. In my view, AI adoption is real, but it's still early. The report cites about almost 17% of US businesses using AI, That's meaningful, of course, but it also tell us there is a long runway ahead. This is how I think about it in simple terms. Into the last year, the winners were often the builders, chips, data centers, and infrastructure. This year, the opportunity may broaden to the users, industries that apply AI to cut costs, raise productivity, and improve margins. But markets that don't only price the future, they price expectations. And if expectations get too far ahead of earnings, even a great long-term theme can get volatile short-term. So I stay definitely positive and I stay realistic. Now, let me briefly bring in Venezuela, not because I want to scare you, but because, in my view, is a perfect example of the world we are in. The report describes a dramatic scenario, targeted US action and the capture of Maduro, creating uncertainty about what comes next, of course. When news like that hits, people immediately think oil spike, market crash. Venezuela produces all about 1% of global oil, so the base case expectation was that the direct impact on global markets and oil prices could be limited. So the real lesson for me is not geopolitics doesn't matter. The lesson is geopolitics can change fast and markets don't always price that risk more smoothly. Sometimes they ignore it until they can. So that's why I don't build a portfolio that depends on the world being calm. Okay. Sorry. So let me let me end this episode with what I'm watching section with a risk that doesn't trend on social media but matters deeply. Debt. Public sector debt is estimated around $106 trillion. That's a huge amount of debt. That doesn't mean automatically crisis. The outlook frames near-term risk as marginal, but it also suggests that sustainability could create volatility in places like the UK, France, Japan, and potentially the US as well. So my view is that in a high debt world, bond markets can react faster than people expect. Currencies can move unexpectedly, and political narratives can become financial narratives overnight. So I stay diversified and avoid confidence. Now, I wanted to close this episode with a more personal way. If you remember one thing from today, I want it to be something like this. The market will try to make you quit. That's what volatility is. The last year, we have seen the S&P deliver close to 18%, and yet the year still felt stressful in real time. Missing only 10 key days could have turned a strong return into a negative one. The rebound from the April low happened in just 55 trading days, so fast that anyone waiting for certainty likely missed it. European banks up 90%, Japan up 50%, Korea up 80%, gold up 70%. Its best year since 1979, and silver up 148%. We have seen the dollar fall 7% in real terms, reminding us that currency trends can quietly reshape returns. And we saw the emotional side of investing in one huge number, almost $8 trillion still sitting in money markets, even after large rate cuts. All right. So if this kind of macro storytelling speaks to you, I'm sure, guys, you are going to love my free newsletter, Macro Mornings. It's read by over 53,000 global investors each week in real time. People, investors like you that wants more than noise. They want clarity, insights, and strategy. It's completely free. You can find the link in the description. I will be waiting over there. And I wish you a great day and bye bye.